Have you ever looked at a company and just wondered what is really going on in there? Are they about to become the next big thing, or are they hiding some huge problem? Well, today, we're going to crack the code.
You know how it is. You hear all the buzz about some hot new company everyone's talking about. But how do you actually know if it's a solid rocket ship ready for takeoff or just a beautifully painted sinking ship? The answer, my friends, is hidden in their financial reports, and I'm going to show you exactly how to find it. So here's our game plan. First, we'll crack the basic code. Then, I'm going to give you two super powerful detective tools, what I call the time machine method and the proportions method. After that, we'll use them on a real-world case file. And finally, we'll cover the 3 rookie mistakes everyone makes, so you can totally avoid them.
All right, first things first, let's get our heads around the big idea here. What does it even mean to analyze a financial statement?
Okay, at its heart, it's all about turning a bunch of boring numbers into a really interesting story. We're just looking at a company's reports to figure out, what are they good at, where are their weaknesses, and where are they actually headed. See, a single number on its own is, well, it's pretty meaningless. But when you put it in context, that's where you find the truth.
This is where we get to be financial detectives. Think about it. The numbers are your clues, but clues alone don't solve the case, right? You need the right tools to connect all the dots. So let's add 2 essential tools to your detective kit right now.
Let's kick things off with our first tool. I like to call it the time machine method. The official, kind of boring name for it is horizontal analysis.
So this method is all about looking at one thing across time. It answers a really simple but super important question. Is this company doing better or worse than it was before? You're basically looking for trends. Is revenue going up? Are costs going down? This is how you spot momentum. It's actually super simple. Think about your own salary. Let's say last year you made $50,000 and this year you made $60,000. So the change is 10 grand, right? You just take that change, the $10,000, and you divide it by what you started with, the $50,000. And boom, that's a 20% increase. See? You just did horizontal analysis. It's the exact same idea for a company's sales or profits.
Okay, on to our second tool. Let's see how this builds on the first. This is the proportions method, or what the accountants out there would call vertical analysis. Now, if the time machine method looked across time, this one looks at a single snapshot in time. It answers the question, okay, how big is each piece of the pie? It puts every single number in proportion to some big total, like total sales, for example.
Let's use another really easy analogy. Think about your monthly budget. If you make, say, $4,000 a month and your rent is $1,000, you can see right away that your rent eats up 25% of your income. That's it. That's vertical analysis. It just tells you how important each piece is compared to the whole thing.
So here's the most important thing to remember. Horizontal is like a time-lapse video. You're watching one thing change over the years. Vertical is more like a pie chart. You're seeing how all the pieces fit together right now, at this very moment, and you absolutely need both to get the full story.
All right, that's enough theory. Let's put on our detective hats and crack a real case. We're going to take a look at some simplified financials for a company called Bruno Corp.
Okay, here it is, our case file. We've got a few key items from Bruno Corp for 2 different years. And look, see that last column, the one that says percent change? That's the horizontal analysis we were just talking about. At first glance, yeah, it's just a bunch of numbers. But let's dig into these clues one by one. Okay, clue number 1. Cash is up 20%. That is a great sign. It means the company has more money on hand, what's called liquidity. So they're in a much better spot to pay their bills or handle any surprises. So far, so good.
Next up, we see their long-term debt went up by 10%. Now, hold on. This isn't necessarily a bad thing. It's a clue that just makes us ask more questions. Like, why did they borrow more money? A lot of times, companies take on debt so they can invest in growth, build a new factory or create a new product.
So those first 2 clues are pretty interesting, but they don't give us the full picture. The real key to solving this case, the smoking gun that ties it all together, is this next number.
Whoa, look at that. Retained earnings jumped by almost 37%. This is huge. So what are retained earnings? They're simply the profits that a company keeps and plows right back into the business. An enormous increase like this tells us one thing. The company was crazy profitable. It's the single strongest sign of a healthy, growing business. Case closed. Bruno Corp is a rocket ship.
Okay, now that you've got the tools, let's talk about the traps you need to avoid. These are the 3 most common mistakes that rookie detectives make when they're looking at financials.
All right, listen up, because these are the 3 biggest traps. First, looking at numbers all by themselves. Second, getting fooled by a really misleading starting point. And third, the classic blunder of comparing apples to oranges. Let's make sure you don't fall for any of these.
This one gets people all the time, the misleading base year. A giant percentage change can look incredible, but it's totally deceiving if the starting number, the base, is tiny. I mean, going from $10 in profit to $20 is a 100% increase, right? But that's not nearly as impressive as a company going from $10 million to $20 million. So always check the actual numbers, not just the flashy percentage.
And finally, please don't compare apples to oranges. It just doesn't work. You can't compare the finances of a software company that has almost no physical stuff to a car manufacturer with massive factories. Their books are going to look completely different, and that's okay. You always have to compare companies within the same industry to get a real, meaningful analysis.
So here's the big takeaway. The numbers themselves don't lie, but they do tell a story. And with these tools, you can finally read that story. The story of a company's past, its present, and even its future. Your job is just to learn how to read it.
And that brings us to one final question for you. Whether you're looking at your own budget, your small business, or that next big company, what story are the numbers trying to tell you? Now you have the tools to find out.